Okay, good evening. Professor York here again. This is part 2 of the BMC. We're going to talk about operations and efficiency. This will take about a similar amount of time, I think about 25 minutes, but it's a great review. I think this is very key because we talked the value side, but we talk about the operations efficiency side because we need to manage our cost side so that we can remain profitable, but not just profitable, so we have ongoing cash flow so we can manage our business and grow our business. So this is this side of the business, and as you can see, there are really actually 4 key parts that contribute to the value proposition from the operation efficiency side. We have, key resources, key activities, and key partners, and those 3 pieces are going to be able to become the basis for which you build your cost structure. Which is very key, which are going to be both fixed and variable costs, which we'll talk a little later on. And I don't want to belabor the finance side, but it is a very important piece. So let's go into the efficiency operations side and key resources. And this is very key, and I'm going to give you a mnemonic that is there called PIPPC. Okay, so as we talked about in class, physical assets, which tend to be your equipment, your physical plant, your buildings, it could be cars and trucks you buy that are there. It could be your distribution networks. It could be even your IT backbone that is there. So P is there. Now IP is intellectual resources or intellectual property, which is patents, copyright, trademarks, and trade secret, which are critical, especially in the technical space, and they create exclusivity, particularly patents. They prevent the use of property or original ideas being used by others. The other P is your people that are in the organization, your human resources, the personnel and talent that are there. And that could be creatives, it could be engineers, it could be consultants that you have. And then last but not least is C, okay, and the C is financial. Why C for financial? Because it deals with capital and cash flow, credit, stock ownership. All this stuff is to drive cash because you need to have cash to be able to maintain the physical, intellectual. You have to maintain your operations. And without cash, credit, or working capital stock, forget about it, okay? And you want to be able to get where you have either ideally non-dilutive capital investment, which means basically you maintain your same percentage of ownership share, but then there is dilutive capital, whereas you go to angels or VCs where you dilute out your ownership share. Okay, the big failure point of most startups is the lack of cash, as Matt had mentioned previously. I think they gave the example of being 2 weeks left in terms of payroll. So key questions you have to ask in terms of resources, okay, are going to be what are required, what's the biggest priorities, how much, and what can you, and how well can you amass these assets, and which can you do directly, what can you do through partnerships, where is your intellectual property critical, what type, how much. I've seen companies which will use trade secrets and to keep things secret and protected, realizing that they run the risk that if it's discoverable, that then it's lost. But if you can hold a trade secret, such as Coke does, for 100 years, it's a lot longer than a patent. But a patent gives you 20 years of exclusivity, and basically so that you can prevent others from utilizing your intellectual property for that particular item. And then what's the value of these assets, how much capital is needed, and when. This is very important. And what type of capital are we talking about? We're talking about debt versus dilutional, equity, and it's dilutive most of the time. And when you have a building or equipment, do you buy or lease, or do you license intellectual property versus go and get the patent? So these are key questions that you need to think about your core resources, because the bottom line is in answering those questions, remember, as a startup, you don't have a lot of cash. So you have to ask these questions, figure out what makes most sense to your business. So activities. So what are activities? Okay, so those activities are the most important actions the firm must take to be successful. And they're requisite for creating the value proposition, the customer relations, market access through channels, and effective. So it's all those different things there. So what are those things, as we talked about? And so examples include, I think we talked about sales and marketing being there, then distribution in terms of your warehousing, and then being able to work with the distributors, handle your inventory, working with your channel partners to make sure that that product that you've produced has been able to get seamlessly into the wholesaler and retailers that are there, and you have to account for the product movement and sales, because that's where you record your sales, and in some cases you may have to pay taxes, e.g. such as in the alcohol business. And then there's manufacturing production, there's problem solving as if you're in consulting, and then one of the other activities there is having a good network or platform, because that may be something that you want to leverage, especially if you are in like the credit card business, or if you are in a business like Amazon that is there, because you can leverage that platform. Okay, but you need to have metrics. This is the key thing in terms of, as Peter Drucker talks about, what gets measured. Okay, what gets measured gets managed. So what we need to think about is, and what Tom Peters, who had In Search of Excellence, talked about, is what gets measured gets done. And there's a great book called Value Drivers. So all aspects of the business, if you are a manager, if you're an entrepreneur, it doesn't matter. You have to measure. You have to measure productivity. You have to measure cost, efficiency. These are things that if you want to optimize your business, metrics are critical, not just in terms of from the sales and gaining sales, but also the efficiency side of your business. And that's where individuals on the operations management side come in and really can have a great impact in terms of really managing the efficiency and the cost of that business so you can get the greatest productivity. And that's what you're looking for at the end of the day. Okay, so what are some what we call KPIs you'll hear, or critical CSFs, critical success factors. So sales and marketing, dollars, quota, units sold, which is, then you have the quota, which is the next one. The ASP, you can have click-through rates, funnel rates, customer conversion efficiency, and cost of customer acquisition, sales and marketing. From production, it may be, your cost of goods that you're dealing with. For problem solving, it's number of solutions you're able to do over a certain time period. And implementation, was your recommendations actually implemented, and did you retain the customer? From a platform standpoint, what I find is important in a platform is they're effective in communicating with other platforms, number of transactions through the system. So you build this platform, you want it to be very efficient, has to be able to communicate with other platforms, and handling traffic. You do not want that website to crash, as we talked about, and uptime versus downtime, which can happen. So here we talked about key funnel metrics in greater detail in terms of efficiency of getting customers into a relationship. But it's not just in terms of that efficiency, but all the money that you do spend to get that customer from being aware to being actually a purchaser, and that's called the cost to activate a customer. And the efficiency being where you move maybe from a ratio of maybe 100 customers or 10 customers to 5 customers. There we have a tool called the Purchase Driver Scorecard, and what we want to do is we want to be more efficient in sort of driving them from prospects ultimately to customers. And then when we do that, our CTAC actually declines. And then the other concept that we talked about is the lifetime value. So once we have a customer, we want to keep that customer and grow that customer, because we want to look at our 3-4 years. We don't want to think about the single purchase, but the long-term value, because we know the cheapest customer we can have is a customer who stays with us on long term. And we don't have to spend a lot of money, believe it or not, in terms of getting that customer, because it takes a lot of money to be able to get that brand new customer. So, some key questions. What are the key activities that our value propositions require? And which are most critical? So again, it gets back to not just what, but what are the most important? And what do we want to hold and do ourselves? What do we outsource to others or partners? Such as, some companies will have legal or have accounting, maybe the customer service, maybe they'll have they'll outsource like having a receptionist, like Ruby receptionist. How do you measure success? What metrics are most important? And how do you get the most? This is the productivity question. Out of each activity at the least cost. And you need to ask about trade-offs in terms of, do I own versus do I lease or rent? Last but not least, of these four pieces that I want to get into is the key partners that are there. And your key partner characteristics are going to be those who are network. It's really a network of firms and individuals and suppliers that really make the model work. You cannot do this on your own, especially starting a business, okay? I run my business, with 2-3 employees, and then I have maybe 8 or 10 other people that help me with my business. And I know a lot of businesses that have what we call partners, and I am a partner to other people's businesses that are there. And they provide the capabilities and products and services that the startup cannot or prefer not to because of cost or expertise, such as, do you want to be having a lawyer on staff that's costing you over $400 an hour, or much rather use as on an ad hoc basis legal services that may be at $400, or maybe you can negotiate and shop around and find a little less. Okay. Also is that you're trying to create alliances that'll create economies of scale, cost reduction, reduce risk in uncertain markets, especially if you go overseas, and acquire specific resources, activities to execute the business model. And that may be your supply chain in particular, or it could be in terms of certain type of expertise that you just don't want to have on staff. So some examples, key suppliers. So your supply chain, your raw materials, your back office functions, your advertising agency, all this is, what we call key supplier relationships. So you really need to think about that, and that's probably first and foremost. So that strategic alliance, that's between non-competitive firms that function to reduce inventory and provide maybe a broader line or service to expand market reach. So, batteries with toys or Intel Insider, two good examples. Competition, like where you have a trade organization where competitors come together. They go for the better good. It may be for a trade show. It may be for a lobbying function. It may be to set standards, and we see this especially in the electronics industry. Then joint ventures between which are collaborative to build a new business or product, and it could be between competing firms. We see this especially where we're talking about trying to bring intellectual and people together and an intellectual property together. And it makes more sense, especially when you have development costs, such as like in a pharmaceutical, which can be $1 billion that's there, where that joint venture makes more sense to share the risk a little bit in terms of bringing to especially new technology. And then you need to ask key questions, in terms of, where do we need these partnerships to make our model work? And who are they and what areas? And you really need to think about who is and where, because these are, while they are not necessarily part of your organization, they are part of your organization, just that they're not employees. They are, and you need to treat them as part of your team. And, when we think about how do we engage them, do we treat them as a true partner or do we treat them as a vendor? I see this with large organizations. They start treating partners no longer as partners, but as vendors. And it changes that nature, whereas a startup really needs to think about a partner being a partner to help their business. And how we engage them is very, very, very key. And then what are the key resources that we are acquiring from those partners, particularly supply chain, and you have to think about other type of services. When you're a startup, you don't need legal, you don't need accounting, you don't need insurance. There are a variety of things that you may want to outsource just to keep your cost structure in line. And that gets with the key activities. And you need to also ask what the cost benefit of, because there will be a point in time where it may make more sense to bring some of those activities in-house versus out-of-house that's there. And over what time frame. So, and that's the nature of the contracts and how your company matures and what available cash you have. And as your company matures, you may say, I need to be more efficient, and more efficient may be when the outsourcing is maybe bringing some of those functions internally. So last but not least is the cost structure. I put a reminder to review the video there, but I'll hit some highlights so that at least we have touched on some of those issues. You know, we talked about fixed and variable costs already, okay? But let's talk about cost-driven, value-driven. We talked about this. Cost-driven is going to be something that's going to be, you know, in terms of more of a generic market, where cost is going to be an issue. Okay, low price value proposition to maximize automation, extensive outsourcing. It's really the leanest possible cost structure. You see that with generic companies, and you're looking at mass market. So Southwest Airlines, a great example. Value driven is where you look at value creation, selling value, it's customization. So luxury hotels, custom chopper shops are there. Tiffany rings, okay? Your major branded items fit into this space. Okay, the branding demands a premium. And we talked about scale and scope. And scale is going to be, with larger output, you're going to have cost advantages. Okay, and that does argue for fixed investment in equipment. Okay, and more mass market approaches. Okay, and as a result, it allows for products, as you think about, those products can be sold at a lower price. So, like the Model T is the classic example. Scope is going in terms of taking cost of as a large scope of operations, and you see that like with companies, multinationals, particularly companies like GE, and they take advantage of things like their advantage of distribution. So we use the example in class such as the Wonderful Company, okay, where Wonderful Company has Fiji water, then it got Palm Wonderful, then it picked up Halos, then it picked up the pistachios, okay, then it picked up Justin, and because they're driving everything, they own the channels, and the distribution channels are there. More products are put through. It's economy of scope. Or we see this in the beer business, where you see InBev that bought Anheuser-Busch, bought Firestone for over $300 million. That's there. So you go up to Paso Robles, you see Firestone City, you understand where that money is coming from. It came from that acquisition from InBev, because now Firestone 805 is going across the country, maybe across the world. Speaking of which, Budweiser, I think, may have been pulled by Anheuser-Busch, because it's not in the top 5 beers. So just interesting factoid that's there. So cost structure that we have to think about, you know, key questions is, how does that cost structure relate to our business model? What activities and resources, you know, in-house versus out-house? How do I take advantage of partners? Do I own or lease? Do I depreciate? You know, when do I depreciate? When I own it? What is my break even, my net present value on an investment? What are the cost advantage of scaling or expanding scope? Okay. Burn rate. What's our cash on hand, which relates to burn rate? How much cash is driven by revenues versus investors? And how much of an impact are expenses on the burn rate? So these are things, how frugal, very important, critical, because you need to, especially if you're a CFO, or chief operating officer, or even CEO, you need to think about these things to keep your business going. Cash is the lifeblood. And if you don't operate your operation efficiently, then at the end of the day, you don't understand your cost structure, you could be out of business. And as Matt gave the example, 2 weeks from basically shutting down the business. So this is a reality that we need to be thinking, and these are questions that we have to think about. I talked about this last week, fixed and variable. So fixed are large, capital intensive. They can be salaries, the IT infrastructure, equipment, or some, and they say static, despite the volume of goods and services, where variable tends to vary in proportion to the volume of goods that are sold. It can be customized and personalized, and here's a few examples like in the consulting space. And then we talk about return. So, for those who work in finance, there's an equation that we use, which is called the break-even point. The break-even point really is that fixed cost divided by the variable unit price minus the variable unit cost. Okay, variable unit cost is going to be the variable production, variable sales, marketing, other that's there. So that's going to give you units. They'll give you break even because we set, basically the equation in terms of fixed, and what we want to do is make sure we have the right units that are there. The other concept is based on time value of money, because you could take $1, put it in the bank, and earn interest. Investors know this. They could put it in the stock market. So they're trading off of investment. So you go and you say, I need X amount of dollars. Say you need $250,000 to get this business moving along. Well, there is a model they call the net present value model. It's a way we analyze present dollars that are invested versus future cash flows. And what you need to just take away from this, what we see here in this little spreadsheet, is in terms of free cash flow, which is our net cash flow from our operations, those get discounted. And that's when you go to finance, you'll understand that there's an equation that discounts your time value of money, because you could have taken that money and you could have put it into the bank. But versus those initial investments, that cost that's there. And so based on your discounted cash flows that are there, your costs, you can be able to come back in terms of what we call a net present value. Now, if it's positive, that means it's a good investment. If it's negative, it may not be a good investment or use of money. We talked about funnel metrics. This is more germane to the entrepreneur. And we talked about CTCA. We talked about also LTV. We talked about funnel efficiency. I think net is, you need to think about the net of the lifetime value of that customer versus the cost to activate that customer. So very, very critical metric that's there. And then last but not least is the concept of cash burn that I talked about in class, which is basically your income statement. If you look at these elements here are your income statement, okay, which is revenues, which for cost of goods sold, give your gross, okay, you get gross sales from discounts, and then you go and you take out your cost of goods sold, you get your gross revenue, and then from the gross revenue, you SGA, and then you get your net company revenue, and then what happens is that you get to a point where we call free cash, or as Matt talked about, EBITDA, which is earning before, I do believe, before taxes, okay, and income taxes. And what you look at is what you also have in the bank. And then you're looking at your spend at your period. So that side that we're talking about, operations efficiency, that fixed and that variable, particularly the variable cost, you got to be aware of what you're spending, because you're burning cash as you're starting a business because people who invest in you have not got the engine behind the revenue model up and revving enough to be able to kick the cash back into the business. So a lot of times with startups, what you will end up having to deal with is questions saying, okay, how much cash do you have in the bank? How many months? And what is the burn rate that is there? Very, very critical to be aware of conceptually. So anyway, that was BMC 2. Hopefully this gives you some insight into the efficient operations. I already talked about BMC 1, so I've broken this up into 2 videos. Hopefully this helps you out a whole lot in terms of being able to utilize your business model canvases. I welcome questions.